Hey everyone, welcome back to Corporate Decoded, the place where we unpack the secrets hidden in plain sight within corporate earnings reports. By the way, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, so buckle up folks, because today we rediving into California BanCorp's latest quarterly report. And let me tell you, there are some major numbers in here that tell a story of growth, of challenges, and of strategic moves that could shape their future. This is their quarterly report, a snapshot of their financial health for the period ending the 30th of September of 2025. Think of it as a progress report for the last 3 months and 9 months of the year, and what a period it has been. Right off the bat, check out these assets. Total assets at the end of September were over $4.1 billion, a nice jump from nearly $4.03 billion at the end of 2024. This growth is mostly coming from their cash and investment accounts. It is like they've been building up their reserves, which can be a good sign, showing stability and a readiness for opportunities. But what about their loans, the core of any bank's business? Loans held for investment dipped a bit, from over $3 billion at the end of 2024 to just under $3 billion. Now, this could mean a few things. Maybe they are being more selective with lending, or perhaps the market is just slower. On the other side of the balance sheet, total liabilities also saw a slight increase, moving from about $3.52 billion to $3.54 billion. Most of this increase is in their deposits, which is actually a positive sign. People trust them with their money. It is like their popularity grew among savers. And then there is shareholders' equity, the owner's stake in the company. This has seen a healthy increase from around $511 million to over $564 million. This suggests the company is growing and becoming more valuable for its owners. Now, for the numbers that really grab your attention, for the 3 months ending the 30th of September 2025, they reported a net income of over $15 million. Compare that to the same period last year where they had a net loss of over $16 million. That is a massive swing from losing money to making it. And for the 9 months ending the 30th of September 2025, their net income was almost $47 million, a huge turnaround from a loss of over $11 million in the prior year. This is the kind of comeback story that investors love to see. This big jump in profit is largely thanks to their net interest income, the money they make from the difference between what they earn on loans and what they pay on deposits. This income surged from about $36 million in the third quarter of 2024 to over $42 million in the third quarter of 2025. That is a significant gain, showing they are managing their interest rates effectively in the current market. And look at this reversal of provision for credit losses. In the third quarter of 2025, they actually reversed a provision for credit losses totaling $15,000. That means they are setting aside less money for potential loan losses, or even recovering some previously set aside amounts. This is a strong indicator of improved loan quality, or perhaps just a more optimistic outlook on their loan portfolio. In contrast, the same period last year saw a huge provision of over $22 million for credit losses. That is a dramatic improvement. What caused this impressive turnaround? Well, a big part of it seems to be the completion of their merger with Calb. In the prior year, they had over $14 million in merger and related expenses. This year, those costs are gone, which naturally boosts their bottom line. It is like finishing a big, costly project and finally seeing the benefits. While things are looking up financially, some expenses did increase naturally. Salaries and employee benefits went up significantly, from about $33 million for the first 9 months of 2024 to almost $46 million in the same period of 2025. This is likely due to integrating the teams from the merger and expanding their workforce. More people means more operational costs, but hopefully it also means more capacity for growth. And how are they managing these expenses? Their efficiency ratio, which shows how much they spend to earn revenue, improved dramatically. It dropped from almost 99% in the third quarter of 2024 to just over 51% in the third quarter of 2025. Even when you adjust for merger costs, the improvement is still very noticeable. This suggests they are becoming much more efficient in how they operate. Let's talk about the money they've set aside for potential loan problems. The allowance for loan losses has decreased from over $50 million at the end of 2024 to about $41 million now. This decrease, combined with fewer non-performing loans, which dropped from about $26 million to $15 million, paints a picture of a healthier loan portfolio. It is like the bank is feeling much more confident about its borrowers' ability to repay their loans, and their non-performing assets, which includes loans that are not generating income and other real estate owned, have also seen a significant drop. This is crucial because non-performing assets can drag down a bank's performance. The fact that it is down from around $30 million to just $15 million is a very positive trend. Looking at their loan book, the biggest chunk is in commercial real estate loans. These make up about 59% of their total loans. While this is a traditional area for banks, it also carries risk, especially with the current economic climate and shifts in how commercial real estate is used. They are keeping a close eye on this, especially office properties. Default in the context of loans means a borrower has failed to make payments as agreed. This filing shows that they have actively managed their loan portfolio, and their efforts to de-risk the balance sheet seem to be paying off with fewer loans going bad. They also have a lot of commitments to extend credit, meaning they've agreed to lend money in the future. These commitments total over $870 million. While this shows they are active in lending, it is also a reminder of future potential risks and responsibilities. So what is the story here? California BanCorp, or BCL, has clearly navigated a challenging period and emerged stronger. The merger with CalB seems to have been a strategic move that, despite upfront costs, is now contributing to their improved financial performance. They are demonstrating a keen ability to manage interest rate fluctuations, a critical skill in today's economic environment. Their loan portfolio appears to be cleaning up, with fewer problem loans and a reduced need to set aside as much money for potential losses. The increase in deposits is a huge vote of confidence from customers. However, there are always areas to watch. Their significant exposure to commercial real estate loans, particularly office properties, could be a concern given current market trends. While their loan quality has improved, any major economic downturn could still put pressure on this segment. They are also managing a substantial amount of loan commitments, which represents future financial obligations. In my opinion, California BanCorp is showing resilience and strategic foresight. They've successfully integrated a major acquisition and are now reaping the financial rewards. Their focus on managing interest rate risk and improving loan quality is commendable. While the commercial real estate sector warrants continued monitoring, their overall financial health appears robust. They seem to be on a solid path forward, leveraging their expanded reach and improved efficiency. Alright, that is our breakdown of California BanCorp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.